we have seen significant increases on the equity side for banks, building up their equity buffers, funded by around twice as much as before the crisis. They've increased their liquidity buffers, which has meant that they rely less on short-term funding. And we believe this will lead to increased resilience to unexpected losses, discourage potentially the future build-up of institutions' leverage, and their reliance on short-term funding. But I think it's fair to say that the jury's still out on the extent of capital or equity funding which is required, as we heard earlier, and the academics obviously will continue that discussion. And certainly the reliance on short-term funding still persists and still can present to be a lethal issue for banks, as we saw with Banco Popular. On the other hand, we have seen, as you've mentioned, also reducing likelihood of too big to fail for banks. So there have been changes, say, to the resolution regime in terms of principles being established, this establishment of this loss absorbing capacity or bail-inable debt, which essentially passes the buck over to private creditors from the taxpayer, which surely has to be a public good. And obviously this has implications for the issuance of holdco and or subordinated senior debt for banks, depending on their resolution strategies, and consequences for other creditors in terms of resolution stays on their derivative contracts, repo contracts, and of course changes in national creditor hierarchies and solvency frameworks, all of which does lead to a reassessment of risk and implications for debt issuance pipelines and pricing. And I know there was a very important point made earlier relating to this risk-weighted asset credibility, and certainly, you know, the final pronouncements of the Basel Committee, which do represent a compromise of sorts last December, do try to eliminate the likelihood of very low risk-weighted assets being generated by these internal models, and really, you know, forcing banks to at least floor a certain amount of their activities using greater amounts of equity, which we think is a positive for creditors. It will improve comparability of banks, although it's still a little bit opaque to go through banks' numbers. And ultimately, we do see that the additional increase in equity requirements for more leveraged banks that may generate very low risk weights, as I say, credit positive. I mean, there is an elephant in the room, however, and it was touched on in the previous panels, and that is the treatment of sovereign risk weights. So this sovereign bank nexus still persists. There was an attempt made last year by the Basel Committee to try to come to an international agreement. They weren't able to. So essentially, many banks holding sovereign debt remain capital free, albeit subject to this leverage ratio requirement. And certainly that appears to be a missed opportunity, and it is very much a political story, and that ball has been passed back to the European Union in particular, where there is a specific issue of banks' significant holdings of their own domestic sovereign debt, and that's, you know, part and parcel of history and the privileged position that sovereign debt still plays in the framework in terms of meeting various buffer requirements, so forth. And I think that really does need to be tackled. And finally, the point around conduct, I think, is very important, and it's still live today. And we've seen examples in Australia, certainly US with Wells Fargo, and also with the ABLV bank in Latvia, where unfortunately US authorities had to shine a light on their misdeeds in order for authorities to take action, and there's still much to be done.